also have a bit of a copy. Alrighty, so welcome then, Pav. As a disclaimer, this is basically for educational purposes only, and that I'll be showing you some live examples, real examples in regards to what we're going to discuss today. But I'm not here to give you any form of advice, and notice that you just got to make sure that trading also could be very risky, and it is important to either get some form of education or have ask a professional from a financial advisor. Okay, so, and I'm offering to deal in any financial product. All right, so just want to take that ahead of time.
Okay.
Alrighty, so we have Elmo in there too. So my mission is definitely just to create a possibility of transforming traders through education and inspiration that will make a difference in their lives through discipline, integrity, excellence, and self-awareness. I just simply use trading as a vehicle to change someone else's way of thinking, because at the end of the day, it's all about mental. It's a mind game.
Hey, Elmo.
Hey, Elmo, how you doing? Elmo, meet Pav, Pav, meet Elmo. So if you have any questions, guys, just let me know. And then our objective today is definitely to show you how to buy and sell institutional price points, because I believe there's a big difference between institutional price points compared to retail price points.
No.
Okay, next. Pav, I've been trading now for the past 24 years. Elmo basically knows me very well now for the past close to 12 years.
Close to that.
Yeah.
You poor thing, Elmo.
I know, right? What about you? 24 years? That's a lot.
24 years, yes. Been trading. I went full time in 2002. Started in 1996.
Wow.
Left corporate world. 2002. I used to be a database administrator. So my background is physics and mathematics and computer science. And then basically from there, got more into investing in real estate, then from real estate to trading. Got my certification in NLP, currently also studying in terms of the master's certification. I believe that also helped in regards to the mindset aspect, because as long as you're a human being, you have emotions, we're also always going to have the challenge, especially when things are going against us. And you're seeing your account going to negative, or sometimes like today, really, really good. Euphoria will also happen. Level of confidence will also happen. So the question now is, how can you control that? Okay, so if you have any questions, please email me, call me. Here's my email address, estraders@gmail.com. It is important to identify first who are the players of the game. Either you're going to be on the left side or the right side. So the left side are your institutional traders. The right side are your retail traders. People will go to seminars, learn the same system, learn the same thing. So the question is, which part of the equation you want to be if you want to play the game? Well, when I started, I was here. I didn't do this on my own. I paid like everybody else. My first seminar, I paid actually 10 grand for a weekend seminar just to learn how to trade options. It was good, but at the same time, in regards to business, I believe in regards to buying at wholesale, or yeah, we can get really at manufacturing price unless if you are the inventor of the actual idea or the product or of the product itself and you're selling it. So when you're trading, on the other hand, it is challenging because you don't know where to buy or where to sell. And then when you're buying and you're learning systems that create some form of indicators, then all of a sudden you are also getting a retail price point. So when I moved to the US, I really wanted to know more in regards to how the markets really operate. And so I met a lot of traders at 2008. And then from there, around 2011, had the opportunity to go to the trading floor. And then just to really fully see what's behind the scenes when it comes to trading in an actual trading environment. So these guys, if you're not an alpha male and alpha female, forget it. Then you might as well be on this side. Because on this side, notice that they don't see charts. What they do see, it's like, just imagine it's a big auction house. You see people, and from there is simply supply and demand. And then from there, once you have that idea, then you can put it to actual charts itself, then you'll have at least some form of an information on what's really happening behind a two-dimensional chart. It's very challenging when you don't know the mechanics. It's like a car. Not unless if you're a car enthusiast, you would know the actual engine, how it operates. But if not, like everybody else, you just want to drive the feeling aspect. If is it a good car or is it a bad car, you want speed. And as long as you know the rules and how to drive the car, then plain and simple. But if you're an enthusiast and you want to know the engine, then if you want to buy a fast car, then definitely you need to know at least what's happening, right? So that's basically the analogy you can get. So an institutional trader is simply someone who manages relatively large amounts of capital compared to most traders. Institutional traders will typically have large positions and hold them for a longer period of time. When they trade, they often trade large numbers of shares at once. So I'm a currency trader. You know, I cannot be a bank. There's no way that even if we combine all money together, there's no way that we could beat them. In the stock market, if you're a billionaire, you can manipulate it. You know, you can buy millions of shares, no problem. But in the currency markets, where it's trading close to $6 billion or $1 trillion in one day, there's no way that we can manipulate it. Okay, even banks cannot manipulate it. So it's often said that institutional traders are the ones who really move the markets. They create the large sustained price changes. Most of the noise in the markets comes from day traders trying to see what institutions are doing and acting according. The remaining investors do not make a serious impact on the market. And it is an actual fact. It's not a myth. It's just the way it is. So when you're actually being on the trading floor, it is overwhelming because just imagine the amount of money and the energy that's in there. So you got to be quick when you're actually on the trading floor. Before it became high frequency trading, I believe to get into a seat, there's a minimum between 10,000 to 100,000, depending on which trading floor you're going to be at. So now that algorithm type of trading is currently being taking place, especially like the New York Mercantile Exchange, for example, floor traders are actually complaining because of the technology. So I met a few of them where they had a lot of challenges trading from the floor trading environment to a room-based environment looking at charts because they can't see who is really behind the scenes or who's really buying, who's selling. And they weren't making money consistently as they used to be because of the two-dimensional chart. So they're now being in terms of a retail environment. However, they still know the game in regards to what to look for. So, but as a retail trader, on the other hand, if you're new to the game and you're in this aspect, this is us, whether you like it or not. Where you buy some securities for your own personal account and not for another company or organization. You're always going to be behind everybody else. So based on that picture right there, you don't want to be part of this group. And the reason being is this. The best analogy I could give is here. The key is to be part of the game. You need to know the game and you need to be with the whale. You need to be this little fish right there, because if you're not, you don't even realize you're being eaten by the big whale. That's what's happening in the trading environment all the time. 75 to 95% of retail traders will always lose. And if you want to be consistent, you need to be this portion right there. So the question is, how can you be with that big whale? Now, whales or institutions will always leave clues. And this is what I got. I took this actual picture right here a couple of years ago. This is the VIX bit, the volatility index bit of the S&P 500. On the opposite side,
Chicago.
This is the Chicago Board of Auctions Exchange, yes. And the reason being, they're still, I still have a few connections there. They still trade on the trading floor. And the last time I took some students there, actually were very lucky because there was like a red carpet because they went through every detail on what it does. It is very complex, especially that's why with options trading, I would never recommend a student to learn options at the very beginning because it is very complex. Yes, it's a really good vehicle to learn for hedging, for risk minimization. But when you're starting out, it is challenging. because there are a lot of factors that needs to be included. So I consider myself as an observer of the markets, which is a type of retailer who observes the movement of institutions to look for clues that institutions leave behind to trade and be with institutions. I just don't deal with just technical analysis. You need to find a factual evidence of why you have to enter. And then you need to look at certain things purely objectively, not using your own perception and you're using your own opinion. Because if you're using your own opinion and your own perception, you're done. Because if you don't have any evidence or facts to create that probability, then then you might as well just gamble. Yes, trading, whether we like it or not, is still gambling. But to be a professional gambler, like professional poker players, they know what they're doing. Trading for me is simply like playing poker too, where the only difference is that you have infinite cards or in a deck. Well, when you're playing poker, you know exactly there's 52 cards in one deck. Trading, on the other hand, there's infinite cards. However, if you can find the statistics or the data that's being given to you and you can create a probability, then you can create a position size and the amount of risk that you're willing to take. So these are the things that are different factors that needs to be put into place. Of course, for 45 to 1 or 60 minutes for us being together is not enough. And hence that's why there's a certain progression when it comes to the learning environment. So that being said, let's go through in regards to some basic foundation. Price will only go in 3 ways. It will go up, down, or remain neutral. That's why if you're playing poker, playing a die or a dice, or even you're playing blackjack, you already have actually playing, trading has the highest probability even at the starting point. Because think about it mathematically, if it only goes 3 ways, even before you press a trade, even before you analyze, you're already up 33% in regards to probability. All you got to do now is to find the 66% deficit in order to create a 100% probability of winning. And then when you're choosing between buying and selling, it then increases now to 50%. Because it will go to your target point or you go to your stop loss point. And then the rest is simply risk management and money management. And that is the challenging part that I also have to master. Do I still make mistakes? Absolutely. I only make mistakes if I don't follow my own set of rules or my own principles. Because everybody has your own values and your own principles. But is it up to you to follow that? It is not up to me or not even up to any of your coach. It is still your responsibility on how you can be disciplined, on how you can maintain your risk management and money management. And it's been proven, I do it all the time. If, say, for example, 3 of us in this group right now, if I'm going to say, hey, and we're going to go through and analyze and what the market is telling us to buy and say, let's buy. The end result will be different between all 3 of us, even though the same target point will be placed. And the reason being is because one will not have the risk adversity or will not take the risk in order to be patient to leave the trade. If the person is neurotic, they will micromanage the account, guarantee. They will panic based on anxiousness or based on fear. Okay, so there is the major emotions that people will always face. So the question is, what causes for the price to go up, down, or sideways? Simply is just supply and demand based on news. Every single price will be based on news. And based on that news, the market will dictate it whether if the price will go up, because they're the ones, are the ones who's going to buy, say, for example, if Bank of America will buy, say, 100 million contracts. And then the rest will just simply follow that and we'll just say like, ooh, that's pretty neat. So let's just buy. Sorry, let's see here. In terms of charts. So when prices goes up, there's more demand than supply. When prices drops, there's more supply than demand. It's a very simple concept. When it's neutral, on the other hand, this is where buyers and sellers are uncertain. And I will show you in a real trading environment that basically what happened in terms of the euro yesterday. Why? Because there are a lot of news that came out, and then out of nowhere, bam, it just went like there's no tomorrow. So But of course, there's also what we call the energy flow of price, where, because whether we like it or not, this is just pure energy. It will vibrate. And this is what it translates to from a real environment when institutional traders are trading. And then the rest will basically follow: retailers, hedge fund managers, everybody. Okay, so there are two components in terms of a chart. Number one is either price or time. In any trading environment, and you're dealing here with technical analysis, there's only two values. You have price and you have time, no more, no less. However, there's a third component when you're now forecasting price, which is now distance. Distance is the key when you're forecasting the probability or the direction. You can actually calculate it mathematically based on force in regards to the vector location. So if you have volume plus the price, then you can create the force of the price itself based on each and every candle, mathematically, to be very objective. And then when you can create that force, let's take Newton's law number 2, force equals mass times acceleration. When there's force based on mass and acceleration in trading, on the other hand, is the speed, or the amount of speed that it went from an opening and ending at closing. And you can create the vector location to the downside or to the upside. And that's one beautiful thing when you're dealing now with advanced technical analysis. Actually, that's one of my favorite topics, and it's teaching the science behind it. And then when you also have the input behind having that thought process on how institutional traders operate between buying and selling, it becomes really easy. What's really makes it challenging in trading is actually the 6 inches between our ears. All depends on your belief system and how many limiting beliefs that you may have. All right, so moving forward from there are 4 different price points. You have a high price, a low price, an opening, and closing. The difference between the close and the open is simply the body. The body of the candle creates the acceleration to the upside or to the downside. And the same thing holds in regards to a downside when the market or when the price opens higher than the closing price. You'll have a high, you'll have a low, you have a close, and you have an open. So, and I'm getting really going fast here, but if you need to know more than happy,
that's good.
It's free. Okay, so some of the terminologies used: bulls or the bears. Bulls is simply when buyers are actually in control, and bears when sellers are in control. Now, when you're dealing with price, on the other hand, when price goes up, buyers will have a disadvantage. Sellers will really have the control. What I mean by that, just really think about it. If 2 of you, and there's only 1 remaining, and both of you have the piece of information that this asset class or this pen is going to go to $10, and there's only 2 of you, you're going to go in an auction house and you know that it's going to $10. So if one of you will offer, currently I'm offering at $2. And if you're being a tight ass, for example, hey, look, I'll buy all of them for $1.50. However, one of you knows that this is going to be worth $10. One will be offering me at $5. Then I will have the power because I will accept whatever the highest bidder is going to bid. Does that make sense? Yes. So that's when price is going up, the seller really has the power. However, when we're dealing just in regards to terminologies of buying and selling between the bulls and the bears, when there's too much demand, price will go up. That's what basically it means. Moving forward, so there's the bulls and the bears. You will know that there's more sellers than buyers when prices are dropping. There are more buyers than sellers when price is going up. Likewise, when it comes to a time-based, either 1 minute all the way to a monthly chart, basically will happen. Okay. So let's discuss about basic economics of supply and demand. What is supply? Well, simply, supply is the fundamental economic concept that describes the total amount of a specific good or service that is available to consumers. Supply can relate to the amount available at a specific price, or the amount available across a range of prices if displayed on the graph. This relates closely to demand for a good or service at a specific price. All else being equal, the supply provided by producers will rise if the prices, or the price will rise because of the firms look to maximize profits. So let's take this one as an example. When there is a high price, which is higher compared to the previous high, this automatically means that someone was willing to offer at a higher price point compared to the previous high price point. I'll say that again. That means that, oh yeah, between an open high and low close, the high and the lows are the two most important price points, because the high price and the low price will be set in stone by an institution. It cannot be you, it cannot be me. Like I said, even if we combine all our money together, there's no one that would be able to afford to buy at that price. Does it make sense? It has to be an institution. So if an institution is willing to pay higher compared to the previous high, then they know something. So on the other hand, it will also what we call an area of supply. That when, this is the most important part, when the high price becomes now lower compared to the previous high, meaning that someone wasn't willing to offer above the last high price point. So this guy knows, and say, now who has the power? The buyer has now the power. Let's just give a perfect example. Both of you are now gonna sell. I am the buyer, because you know that no one's willing to buy it at the higher price. I'm gonna go through and say, hey Pab, how much are you willing to offer? And say you're gonna say $2. How about you, Elmo? And you're gonna say $1.50. You know what? I know the piece of information that this pen is not worth $2 and beyond, and this pen isn't gonna be worth $1.80 either. And now you're offering me at $1.50. I'm gonna say I'll give you for $1.45. Take it or leave it. Both of you is going to snap that as fast as you can, especially if you have that piece of information that this piece of pen is not worth $1.50 because it's gonna be worth $1. So the person who will snatch it the most, boom, then now I'm gonna go like, haha, beautiful. So that now creates a supply where there's a form of resistance of sellers. Just imagine, and this is also the terminology support and resistance, which actually when I learned, nobody really taught me what the meaning of support and resistance. Oh, it's just, you go to support and resistance. And I went to the floor, I'm like, what does it really mean? And I said, well, they don't really say support and resistance on the trading floor. They will say supplier demand. Then they will see it. Oh, it's at supply, boom, you're gonna sell it. Oh, it's in demand. And mind you, institutions will be either buying or selling bit by bit, that when it comes back up, they will sell again. It will come back down, it comes back up, they will sell again. And then they're slowly selling, or they will slowly buy, because just imagine, if they will sell everything all at once, SEC will be on the phone with them. But you know what? Sometimes some institutions will just pay that fine, because if they know they can make billions of dollars, then what's 10 million for them? It's just the cost of doing business. They won't even fight it based on the laws and so forth. They will say, hey, you know what? Here's the fine, let us go. But if it's you and I will have that piece of information and we're gonna do it, guess what? You gotta be in jail for 25 years. That's what happened. That's what happens with inside information. You can't do that. If you're a congressman, on the other hand, then you have the piece
of yeah, no problem.
You can't do it. That's how it's really screwed up in terms of the system. So, but nevertheless, moving forward from there, here is just an example in regards to, notice that there is the high was willing to go for the previous high, then all of a sudden no one was willing to go beyond that, and this is what basically drops, where it will create a demand. Or zoning as an example, or another terminology of area would be a zone. So it's like a plus or minus. It's like real estate. If you go to an auction house or an auction place in real estate, there's a plus or minus. It will go above it or below it. Now, in the heat of the moment, if you really want that property really bad, and that's what's happening in California, like it's ridiculous. People will pay for anything. And that's why the valuation of real estate will always keep on going up, especially when there's a lot of demand for it, okay? So demand is simply an economic principle that describes a consumer's desire and willingness to pay a price for a specific good or service. Holding all other factors constant, an increase in the price of a good or service will decrease demand and vice versa. So let's take this one, for example. The low is lower compared to the previous low. Then someone was willing to snatch based on what the buyer is actually offering. On the other hand, what happens if it reverses? Well, if the low will be high compared to the previous low, as an example, then bam, then there's going to be a support of buyers. So that's what support means when buyers are supporting price points, especially when you see a bunch of higher lows and they're not willing to go below that. Those are the clues that we need to look for. Why is it that the price is not going lower? Then that means that they know something. And who are they? Institutions, not you, not me. And this is where you go another step in regards to finding and more evidence on what the up and coming news are going to be. For me, looking at the macro fundamentals, looking at up and coming news is very important, especially high impact news. Yesterday, for example, you had the Feds, the FOMC meeting minutes. Today, you had the ECB. So all these things play a big role. Why? Because of the whole global macroeconomics. It's not just one. As well, when a trade or someone teaches just in technical analysis, it's not enough. Technical analysis is not enough in order for you to find an evidence whether you're going to be buying or selling. You need to back it up. The question is, what are you going to do to back it up? What are the pieces of information in order for you to back those up? Okay. So here are just simply some examples, but what I'll do is I will go through a better one. In actual fact, I'll skip to this one right here. I'll just show you first this one so you can have a better idea. So here on the left is based on the analysis. So I systemized a certain, actually with the help of some students, they created some form indicators, like in terms of where the highs and lows are. And likewise for the trend lines, I don't do it anymore. I actually do it automatically. So the application will do it automatically just to define it. And then from there, they go in hierarchy. Trading methodologies go in hierarchy. So let me open up basically trading view here just to, I won't use trading view, I actually use this one. I use still FXCM. FXCM is no longer available here in the US. I use FXCM and I also I love using trading view. Trading view is a really good web-based application in regards to charts, because you can, it's a free based application in regards to, especially with price. We know you have CFDs as well. So, but my focus is simply just currency, where I also deal sometimes with futures because I need to look at the whole markets in general. So, but when I'm teaching, I use Forex as a vehicle for learning, because I really don't want the student to open a $25,000 account, even $1,000 or even $10,000. I believe 300 to 500 bucks is more than good enough, because it is imperative for the student to find their own statistics. Also to prove the theory actually works in real time. And then once a week, we do what we call a group coaching session. That group coaching session is important because we need to identify what caused in terms of the inconsistencies. Because at the end of the day, it's got nothing to do about the system. It's got nothing to do about technical analysis. It's all about psychology. So why didn't you follow the plan? If the plan was to buy, then why didn't you buy? Or why did you get out? Because it leads down, and this is where people don't understand, is that to be consistent at something, you need to put the effort into it in regards, not just the learning, but when you're putting a live trade, and then you need to be disciplined. It's the being. You need to be disciplined. You need to be committed. You need to have the passion. You need to have the desire, and so forth and so forth. So, but nevertheless, going back to TradingView is a really good application. And then once I can see there, then it's easy to put in a trade. So for me, I use Wanda here in the US and Forex.com, because in the US, Pav, it's only 50 to 1. I know in Europe, I believe they changed the leverage to down to 30 to 1. But even Australia,
why don't you do Australia? They've even got 400, 1,000 to 1.
I can't, because now that I'm a resident, I could be in trouble.
Shit.
Yes.
All right, trade through me.
Because in Australia, you can still have 200 to 1. And then sometimes if you have accounts in Cyprus, you can go 500 to 1.
No, 400 to 1 I'm getting in Australia, Owanda.
Wow, Owanda, nice. So that's why, like, you know, you're doing with 400 to 1 leverage, you know, even $100. Can you maintain consistency at the very beginning to do with $100 account? If you can do that and you can do the process and you create a good habit, then the process should be the same. It doesn't matter now from $100 account to 1,000, 10,000, or 100,000. Yes, the only difference is the amount of zeros, and also the amount, or meaning the what you mean in regards to your meaning when it comes to money. Because sometimes people cannot handle a 6-figure trading account. How about a 7-figure trading account? It blows people away, right? And then, of course, you also have to go through in terms of the risk management aspect. But when you're dealing 400 to 1, my rule, because it's a 50 to 1 maximum, is 10% in regards to risk. But if you're dealing 400 to 1, I believe you can go beyond 1% in regards to the amount of position size you have to put in. Because it's easy to make money for 400 or for higher leverage, but you can blow up your account really, really quickly too. Because now the idea is to manage the account while you have a highly leveraged tool. So when you
starting to learn that, already blew 3 accounts.
Gotcha.
So I'm starting to learn that.
Yeah, and it's not about risk minimization basically from there. All right, so going back through here, let me go through the other one because it's actually easier. So these lines have been designated by the software or the indicator itself. So notice that every point or arrow is being dictated in regards to a low price of an institutional price point. And then basically from there, we create what we call zonings and say, for argument's sake, this is before this one existed, you have this.
Shit, that's nice.
So you have at least approximately 300 pips in regards to range. So if you know that value, that there is a demand of around 300 pips, then this area or this zone is buying time. You can't go gung-ho at the very beginning when price is dropping. You can, what we call, keep testing. And then you see some form of confirmation, then you keep on adding more, and this is where the law of averaging up happens. Can you average down? Absolutely. However, when you're calculating that, then you need to have a proper calculation on how much you're willing to buy based on this area, and from there is how much you're willing to lose. This one, the lowest low, this is a major one. This is a major price point where if you don't want to get stopped out, a guaranteed stop, you need to put your stop loss below this low. And then when you have a clear direction, the price is going up, this is now where you can trail your stop loss to the last low. Well, here there's nothing. You only have a bunch of higher lows. When you're seeing a bunch of higher lows,
when does the arrow, sorry for interrupting, when does the arrow indicator inform you there?
Ah, very good question. When a higher low will be formed, meaning that an institutional buyer or seller, especially a seller, is not willing to sell lower compared to that price. When you have that confirmation and no one's willing to go below that low, you're in a safe haven.
Right.
That means that the odds that it will either correct or rebound is highly probable. When I found and I figured this out, I'm like, man, this is like having a crystal ball in your head out of everybody.
I've got a similar program that I'd like for you to see
my
actually one day.
I'm sorry?
I said, I've got a very similar program that I'd like for you to see one day.
Oh yeah, sure, Pev, absolutely. And then now basically from here, from this area of demand, from a point of demand and supply, the midpoint is what we call equilibrium. A lot of traders will use moving averages, correct? They will use 200, they'll use 50, they'll use 20. What people don't understand is that they don't know the purpose of a moving average. Why? Because they've either been taught that, hey, you know what? The price goes above a moving average, you buy. It goes below, you sell. The question is why? One time I was in a class and I asked them, so why do I have to buy it above a moving average? What's the purpose? Because the system said so. I'm like, dude, then why am I going to use your system? You can't even bloody explain why I'm using it.
That's right.
Every indicator has a purpose. So mathematically, a moving average is an equilibrium. It's an average between two price points. And then through there, a simple moving average is just the amount of days or based on the time frame calculated divided by 2. You add them all up, you divide by 2, that's the average. Then it will create some form of like this, a wave because of the average. That's what it mainly means. So that's why when you're using a system with a moving average, which this is a system, you are getting at retail price point. What I'm sharing with you over here is you're getting at wholesale price point, at institutional price point with the lowest price, obviously with the lowest risk as much as possible. That's the idea. And then from there, when you have other systems that will create simply like a confirmation, hey, let's buy more, you got to go in, because what simply means a moving average is a trending indicator. That's what it is. It's a trending indicator. So when price is above a moving average, meaning it's, for me, it's telling me, hey, look, the probability, remember, I'm using the words probability. I'm not saying it's going to go up. It's just a probability. The probability that price will continue or will change its direction to the upside is highly probable. That's what it just really means. So when price from a downward, when price is below a moving average and all of a sudden it's now going up, for me, this is what we call part of our methodology. This is called method 3, because every methodologies or every trading system will go in hierarchy. They're not the same. Not all trading systems are created equal. I will say that again. Not all trading systems are created equal. And the reason being because of the location of price, especially if you're using indicators that are lagging, meaning that because of the calculation of the price, you're always going to be late. So when the system says you buy above a certain moving average, or the system says so because of the indicator, it's always going to be at retail price point. So like this one, it's saying for me, hey, you got to buy. But the price is now at supply. And how do I know that? Because every time that it wanted to come back, see, it tried to come back, it would come back down. It tried to come back, came back down. This was a supply, but at the same time, an equilibrium between that and that. Can you see it? It's clear. It's an equilibrium price point. And then now that supply changed to a demand. So this has a lot of force. Why? Because buyers, they did come in and sellers disappeared. But where is the next area where it's going to test? This high right there. That high, and why do I say that is because, look, this is a very forceful candle. Technically, the price should be going up here. The question is why? Why didn't it go up? Why did it come back down?
Because if you look in the past, it showed support in the back and some resistance.
Very good. Especially from this side right here when it broke out and then it came back down.
That's right.
This one too is also based on, when you see all these type of movements, they're all based on news. Something happened within that event. And that's where, very good, Pav, when you're looking at price, is also going through in the past, where did they touch? Plus or minus, and that's why the zoning is important. That's where it all happens. Okay, so when that happens, like here, what are the odds that they will retest and break this? In my opinion, the odds that they're going to break it is highly probable because it's not enough. It's not as thick compared to, say, this one or here. So if this one gets broken, they will retest this price right there before we'll go to that price over there. And why do I say that is because of this. Let me annotate it for a sec. Looking for my annotation tool. So I want you to look at this and there, see right there and there. Of course, this was the recent one. Look at this line right there. They broke it. This is a very good sign. This is how breakouts happen. Not only that, look, you have the low price, which is higher compared to that. You have a higher low. You have a bunch of lower lows. Sorry, not lower highs right here. Beg your pardon. This price broke out this. Now you have a higher high. So you have 0.1, 0.2, 0.3. Then somewhere, sometime, either 0.4 will be higher than 2 or lower than 2. Those are only your two combinations. However, they're like ceilings. They need to break this price first, that price, and then before it will go through there. And then now if we're gonna add like Fibonacci's, for example, and this is how the powerful Fibonacci, look at that, it just touched through there. Then the 50th percentile, which is also a very valid point. That's the way the next target point is between 110.65 and 111 within this area. So we still have approximately 110 pips in terms of distance to get up in there. Okay, so that's how supply and demand simply operates. And I could keep talking here. However, this is just the part of the basic element in regards to proving a point that institutions will always leave clues. How is through those lows. And it's nothing got to do just looking at a chart and like, okay, I'm going to do this, do that. And this is something that I didn't realize, not until I went to the trading floor, and then someone explained to me a little bit more about supply and demand. And I'm like, huh, that makes sense. So when for me something makes sense and it's very simple, I prefer when things are very simple. When you do things in a simplistic manner and you can understand it, then it becomes way easier. Does that make sense?
I agree. I can't agree more.
Any questions before we move on?
Actually, do you trade this system here that you currently showed us?
Yes.
Okay.
Yeah. So the method, because this in terms of the basics, it can lead to more. It can also be very complex, even though it's very simple, but it's all very complex because there's a lot of values and factors that you have to add in. However, once you know the basic element, the basic foundation of supply and demand, and then for me, the next step I do teach is actually the two methodologies using two indicators. And then from there is different strategies. I have like a trifecta, we call it the trifecta, like you're playing horse, because it goes 1, 2, and 3. You are buying and then one will come in, like now say today you have here, the third methodology is basically saying, hey, you got to buy. So when I'm buying, when price is too expensive, I do not buy, like in terms of, say, if the system says you got to buy, say 50,000 units of the euro, for example. I'm not going to put 50,000 units. I'm going to buy in, say, only 10. And when it corrects itself, so because price is too expensive, so I need the price to come back down If it comes back down to say to 109 at the cheaper price point, back to demand, then that's where I want to go more, because the system is saying to go long, but can I get it at a cheaper price? Absolutely. So through there, when I get a cheaper price and we'll continue, awesome. So, but we can also buy at the closing price. Yes, I would. So I will not have the form of regret, because sometimes in the past, I said, I'm going to wait for the price to come back down, and never did. It just keeps going. And that's, jeez. And then now I'm chasing it. I don't want to chase. So if the system says to go, then I'm buying just a very small portion. It will come back down. I will buy more, but at least I'm in the game. So the most important part is when you're in that game, then you'd say, for example, tomorrow it goes another 100 pips. Then you would rather feel good that you're in rather than not being in. Does that make sense? So that's strategies in terms of trading. There's almost not infinite, but there are different ways in order to enter, re-enter. And then you just have to see fit in regards to how much you're willing to put in. So like say what I did here, based on what I showed you on this side, because I got in on over here at the cheapest price, 107,786. I bought in more 108.15. I bought more 108.61. There's more down here on the bottom. So this is the history of the actual trade. And then what I did is I got out 80% of the positions, begged about close to $800. And then when it came back down earlier, 109.25 around that area, I bought in again. So now you're taking some piece of the pie, put it into your account, and it comes back down as long as there's more. And this is what I learned from this guy, actually, from the trading floor. One of my students basically asked, I said, hey, what's the key? What's your success that you're trading for the past 30 years? He said, is you need to take risks. He said, calculated risks. And they always say that greed is always good, as long as there's more. Greed is no longer good when there's no more. When you keep on asking for more, but there's nothing more, like say, for example, this one goes up and it comes back down, but you're waiting and you're hoping, that's not because you're just greedy, because you're hoping it can go more, but doesn't want to. Then it kicks you up in the ass because it's not going against you, just because of your greed and your ego of righteousness. So those are the learnings also that I had to learn.
But in a situation like this, for example, wouldn't you move your stop loss?
Oh, no, exactly. So that's why now the stop loss is now.
See, I'm sorry for interrupting, but Elmo's talking too much. That's why I'm a bit confused.
Sorry, my bad.
So yes, so when you're doing in terms of risk management there, Pav, absolutely. Then it is imperative to trail the stop above breaking even. Now you have a zero risk free trade. We have infinite reward and zero risk. That is the best trading system. If you're asking about a trading system, then that's the best. And that's what
yeah, absolutely. It's just, I'm just trying to figure out those. Sometimes it's the entry that, of course they say it's the exit that's the main thing, right? But it's where to get in sometimes, because you have a look at a pattern, you know, and if it's on the high and you're within the range and it's the high and you say it's going to drop and all of a sudden it breaks out, you know, like.
Yeah, absolutely.
It's identifying.
Correct.
Yeah.
To be honest with you, Pav, they're all relative. It's not just the entry. Of course, you also need to have a good entry. It's not just the exit. You also need to have a good entry point, right? Because sometimes an entry could be an exit at the same time. If you made a mistake, then that would be one of the possibilities. Even if you screwed up with just pure luck, then you're just lucky. It's all relative. All right, so moving forward, basically from here, as Jesse Livermore basically states, to invest or speculate successfully, one must form an opinion as to what the next move of importance will be in a given stock or speculation. is nothing more than anticipating coming movements. In order to anticipate correctly, one must have a definite basis for that anticipation. Very important. Alrighty, so if you have any questions, please feel free to email me here. You can basically call me at any time. And then if you want to learn more for free on what we discussed here, there's 17 modules that you can learn basically by yourself. It's very similar. It's recorded like this. You see me, and you get a 30 days in terms of free trading support basically from there. Why am I doing this? I believe because of COVID, there's nothing better than you learning right now. It's no excuse, to be honest. And then from there, if you need to know more, like in regards to then, this is the entry level, intermediate level in terms of the methodologies, the strategies. Then of course, that could you can also do it via online learning like this, or a one-on-one situation. Other than that, guys, it's 2 o'clock. I'm sorry, I have to go to my next meeting. Thank you so much for coming in. Pav, been a pleasure meeting you. Elmo, good to see you online once again. What happened to the rest though?
Thank you.
Other than that, I
nice to meet you, Elmo.
Nice meeting you, Pav.
I'll see you guys again, hopefully.
Yep, and have a safe flight back to Australia there, Pav.
I hope to see you before then, but thank you very much, mate.
Thank you, sir.
Elmo, are you in the Philippines?
No, he's always here in the Bay Area.
Stuck
Bye,
in
guys.
the US, mate.
See ya.
See you later.